Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Ernest Wong, head of research at Baskin Wealth Management, will be joining us for the hour. Then in 30 minutes, we'll be joined by Nick Setyan, managing director and senior equity research analyst at Mizuho Americas, to dive into Starbucks' new tipping program and what it means. We also want to hear from you, of course, this morning on First Call. Reach out with your questions on North American large caps, and we'll have Ernest answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Barrick Mining is slowing development of its Reko Diq project amid escalating security risks in Pakistan. The company says it will scale back spending and extend its project review until mid-2027, citing worsening regional security conditions and potential increase to capital costs. Barrick still sees long-term value in the project, but warned costs could rise from earlier estimates of roughly $5.6 billion to $6 billion for Phase 1. Energy Capital Partners agreeing to reacquire Energy Solutions in a deal valuing the business at about $2 billion US. The buyout firm is returning to the Salt Lake City-based company 4 years after selling its majority stake to Artisan Capital Advisors. The move comes as AI growth, data centers, and electrification drive power demand, boosting interest in nuclear services. And now our top line story. Markets are on edge this morning. You can see how mixed they are right now after U.S. President Trump took to social media overnight, threatening Iran's energy infrastructure ahead of a new deadline to reopen the Strait of Hormuz. The post comes as U.S. allies push for a last-minute ceasefire. Oil is holding near $110 a barrel, but shipping remains limited. More on what this means for investors. Let's bring in our guest for the hour, Ernest Wong, head of research at Baskin Wealth Management. Ernest, thanks as always for joining us. I don't even know how to ask how do you even predict what's unfolding here or what's next?
I think the
reality. Do you have a big crystal ball or just a little one?
I think the reality is that you basically can't predict what's going to happen with these kinds of things. Obviously, I'm talking beyond the wild tweeting and those kinds of things, but
they were wilder than usual, it felt like, on the weekend too.
Yeah, and whether the motivation there is posturing for negotiations, I don't really have an opinion on that. I think what the lesson that we've all learned from not just the Iran crisis right now, but also from 2022, is just how reliant the world is on a lot of these things that are being manufactured and the supply chains on places like Qatar, not just for energy, but for things like fertilizers, for things like helium to make chips, for things like sulfur to refine nickel. And I think that every time there has been a crisis like this, the world has responded in a way to diversify their supply chains out of that region and look elsewhere.
And that's really a healthy thing, though, isn't it, at times?
Yes, and that's exactly...
It's like not putting all your eggs in one basket.
And that's exactly what we saw after the 70s, when there was a similar event in the Middle East. The world shifted towards developing oil resources in other parts of the world. The world started to move towards energy efficiency and renewable energy, and I think we'll see a similar push like that going forward.
Now, one thing with the Strait of Hormuz is the big thing about this, but at the same time, we've seen Saudi Arabia divert it has a pipeline going north to the Med, I believe, right? It's diverted more oil towards that. Could that be something that they consider on a larger scale?
On a
larger scale, that they can divert most of their oil and go north with it rather than try to get through the Strait of Hormuz.
Well,
not now, but like longer term.
Yeah, so I think that is certainly something that is going to be. I think all options are on the table at this stage. I think the Middle Eastern suppliers are going to be looking for ways to use both existing infrastructure as well as building new infrastructure to really look for alternative market access following this event. And I think the pipeline that you mentioned is going to be one example of that.
And you talk about we found alternative sources. Are there more alternative sources for those things in the world? Is this something Canada, could we see a benefit from this?
No, I think certainly Canada is very, very well positioned to be benefiting from this. We have oil and gas, obviously, but we have helium, we have fertilizer, we have sulfur, and I think it will be on the government of Canada to start to develop market access to other places and really show that Canada can be a reliable supplier of these products in the future.
Do we have the guts, do you think?
No, I think certainly the Prime Minister is making the right moves. And especially with the CUSMA review coming up, I think that there will be a lot of interest from both Asia and Europe to look to Canada as a supplier of these things as well.
And how are you approaching this from an investment point of view?
So I think our approach from an investing perspective is we really don't focus on the headlines and try and trade in and out of these things as they happen. But what we try to do is focus on owning high quality companies, because what ends up happening is that the stronger become stronger during these times, and they end up gaining market share, maybe through acquisition or by holding lower prices, and end up stronger on the other side.
And are there any companies that are standing out when it comes to that are looking well placed in this?
Well, so certainly a company like Costco, for instance.
Yeah.
Costco is known for having the lowest gasoline prices. They usually benefit from higher gasoline prices because people are looking for value. And so as more people look to Costco for lower gasoline prices, they get more memberships, and they end up gaining market share over smaller chains that do not have that ability.
And can they weather the inflation better than the smaller companies then too?
Oh, for sure. Because
I mean, that's one of the big things I think we're looking at right now. March numbers are coming out. I think we'll see some numbers we won't like.
Exactly, because again, Costco is the cheapest place that you can buy high quality produce. And so this happened in 2022 as well, where Costco was a massive beneficiary of inflation in those times, because not only did their profits go up because of inflation, they also gained market share by having lower prices than other retailers and higher cost suppliers.
And we've been pretty lucky in Canada, because I mean, you're starting to hear the horror stories in Asia about massive restrictions for oil, and yet we've felt it at the pump, but we have not felt it beyond that.
No, and I think that it is really I think that's one of the understated benefits of this. You never want to benefit from wars, but Canada is going to end up benefiting from this event, both directly through higher tax revenues, through the economic potential generated from higher oil prices for the oil companies, and longer term as we are building out the infrastructure to help really sell our natural resources to the rest of the world.
All right, we're going to take a break on that note, but we're going to be back. And first up, though, we'll take a look at the markets before the bell. Well, let's see how things are shaping up on the markets. We'll start with the U.S. futures. And not surprising, bit of a mixed bag right now as you look at them after the long weekend. I don't think anybody quite knows what to make of all the recent comments. We're hearing reports that there's another ceasefire proposal on the table. But we also have Trump threatening to bomb Iran into oblivion again. So the markets, there you go. That's what it leaves them at. Elsewhere, the Asian markets closed for a holiday, so not much to tell you there. Or sorry, it was a mix. Nikkei was open today, and it was up 0.55%. And taking a look, Europe was closed for a holiday. The TSX, of course, this is the Easter weekend. It was closed on Friday. What did it do on Thursday? Finished the week on a positive, up by nearly 0.5 point and well above 33,000. Some of the movers and shakers. Transcontinental up by 8.64. Curaleaf by 8%. Going the other way, Go Easy down again, 6.66%, foreboding, and Rogers off by nearly 8%. Looking at the metals now, and you can see gold starting its upward trend again, for over 4,700, up about 0.5 point right now. Silver pushing above 73, it's up 0.75 point, and copper is on its way up after kind of dropping for a bit, up 1.44 at 566. And oil, Western Canadian Select from Thursday. It was up nearly 7%, over $80 a barrel. And WTI today, let's see where it's going. Yeah, it's off slightly. Again, everybody trying to figure out just what is next in the Middle East. WTI at 110 a barrel, but down 0.7%. Of course, Iran is dominating the headlines, but our guest says the July review of CUSMA is far more critical for Canada's economy. About 70% of the exports go to the U.S., and a failure to renegotiate could significantly hit growth and jobs. Let's bring back Ernest Wong of Baskin Wealth Management. Ernest, it's been lost in all the headlines. It's been lost in all the chatter, but it does matter. And as much as we talk about trying to find new markets, the U.S. is still the U.S.
Yeah, I think the reality for Canada is that the trade relationship with the U.S. is going to be far more consequential for the economy compared to anything that's happening in the Middle East today, because it's such a large portion of the Canadian economy. I saw one bank estimate that if there was a unsuccessful renegotiation of CUSMA, there could be up to 10% unemployment, negative 6% hit to GDP, which is
wow.
Obviously quite material to everything that's happening.
Mm-hmm.
No, I think that obviously we've seen the government and Prime Minister Carney make moves to try and diversify the Canadian economy, such as the deal with China to import electric vehicles and sell canola. But these will only go so far.
Yeah.
Canada really does still need U.S. as a trade partner. But I think the other thing that is not appreciated enough is that the U.S. also needs Canada as a trade partner, because most of what Canada is supplying to the U.S. are natural resources that cannot easily be replicated or found alternative sources in the U.S.
Now, I would say the war is probably reinforcing our value to the U.S. in many ways.
Yeah, I think so, because if we look at things like rare earth minerals, or of things like helium to manufacture chips, again, these are not things that the U.S. has supplies of. Mm-hmm. And Canada, we do have these things. So I do expect that these are going to be things that are being addressed as the two parties sit together and renegotiate.
Of course, but again, it boils down to Canada has to have the ability and the want and desire to actually get these things.
Yeah, and I do think that from the country as a whole, there has, because of the weak economic performance and partially because of the renewed discussions on trade, there has been a focus on developing the economy, streamlining things like energy projects and pipelines, or even developing a new helium liquefaction plant. Mm-hmm. And so I think the country is moving in the right direction.
And then on the other side, we're talking about bringing in Chinese EVs. We lowered the tariff on that. How does things like that sit with mostly how do they sit with Donald Trump? But how much of an impact does it actually have on the negotiations? Because Trump isn't the only person at the table. There are a lot of other negotiators involved in this. That's
right. And so I think auto jobs is clearly one of the things that Donald Trump has been vocal about wanting to bring back to the U.S. And in this specific case, I think that it's more targeting towards Mexico, where a lot of the jobs in both Canada and the U.S. have shifted down to Mexico for the auto sector. Now, I think that it's kind of unclear about what BYD's intentions are, where they announced to open dealerships in Canada. Are they planning to import all the cars from China? Are they
slap the last bits together here, put a label on it?
Or are they've talked about opening actual facilities in Canada to sell domestically? So we'll see how that plays out. But Mark Carney has said that he doesn't expect this to be an issue with regards to the upcoming negotiations.
Anyway, I mean, the reality with the auto industry, I mean, Toyota and Honda, I think we're manufacturing more of their cars than we are the big three in Canada right now.
That's right, and I think that if you look through the history of the Canadian and the North American auto sector, there have been times of foreign market access into the country, where first you had the Japanese, then you have the South Koreans, now you have the Chinese automakers, and I think that they'll probably play by similar rules if they want to access this market.
What do you think could be a big stumbling block for CUSMA?
Well, I think that there's probably going to be I think that there is probably going to be quite a bit of volatility on the part of Donald Trump. How that ends up impacting the negotiations. I think that there are certain aspects such as supply management, which Carney has already said are, and which the U.S. has, feelings about that. And so I do expect it to be a contentious negotiations in certain aspects, but ultimately successful.
I mean, because there is that reality with all the people, and they realize maybe we don't need the trade agreement as much. So there is a
right, and that's what we saw in the surveys, where I think something like half said that we don't. That is really a failure of most people to understand just exactly how intertwined the Canadian economy is with the U.S.
All right, we'll wrap it up there, Ernest, but lots more. Next, private credit risks are back in focus, with redemption limits exposing the downside of products often marketed as safe income. More on that next. Private credit can concern with some U.S. and Canadian funds limiting redemptions. The concern is that these high fee leverage products are being sold as safe income, raising questions right for individual investors. For more on this, we're back with Ernest Wong of Baskin Wealth Management. And Ernest, how big a market is this globally, and where does Canada fit in?
Yeah, so I think we've seen some large announcements of private credit funds gating their products both in the U.S. and in Canada. I think in Canada it's a relatively small market overall. I think about $80 billion. In the U.S. it's a lot bigger because the private credit firms have really taken over, filled by that the banks left over after the financial crisis. I think the issues are a little bit different in the U.S. versus Canada, where in the U.S. they are more focused around exposure to software and the lending that these firms have made to fund software private equity buyouts. In Canada, the private credit space is more focused on real estate. So things like
both kind of risky right now, though, aren't they?
Exactly. And so we've seen in both U.S. and Canada, we've seen some firms have to gate their products where they're really halting redemptions and leaving investors unsure of what is going to happen to their money.
So, and what can people do if they're involved in this? There's not much, really, can they?
No, the reality is that there is not much they can do, because I think what private credit is fundamentally is that these are high fee, these are levered, these are high risk loans that are made to people who don't qualify, and companies that don't qualify for traditional mortgages or for regular public market debt. So that's the reason that they go to private credit. Now, I think that these types of products might make sense to institutional investors, such as a pension that has a very long and predictable liability. But for individual investors, I think that the unfortunate thing is that they were often marketed as safe fixed income replacements, where they would get maybe 6, 7, 8% guaranteed interest rates. They were promised kind of immediate liquidity on a 30-day basis if they required it. And as we're seeing, that's not happening.
How large the retail market is on this? Like how many individual investors are involved in this?
Well, I think in Canada, one figure that I've seen is about 10 to 15% of high net worth portfolios are allocated to alternatives. Now, that doesn't include, that's not all private credit. Now, there's private equity, there's hedge funds, and other types of products that might go into this. But it is a non-trivial portion and increasingly growing allocation to investor portfolios. And
where should people be looking with it, or what should they be doing with it? I mean, if you're in it, you're kind of in it, right? You're kind of limited what you can do at this point, but is it still worth getting into at all?
Well, I think that there are plenty of public alternatives that investors could be getting into. So if you to exposure to real estate, you can buy public REITs. These are often high quality portfolios of real estate that are trading at discounts to net asset value. For example, you can buy Canadian apartment properties. You can buy First Capital for strip malls and those kinds of things. And these are high quality properties that are providing adequate yield, that are promising immediate liquidity if you change your mind and don't want to have the investment anymore, right? So I think that, and for people who want fixed income, I think they should really understand what private credit is and understand that, are you really looking for higher yield, or are you looking for something that is safe and going to protect your money?
Yeah, always things you got to be weighing. Does it look like we've kind of hit the bottom with this, or is there?
Well, I think what's going to happen is that now there's a lot of firms that are halting redemptions. They will probably have to proceed in an orderly wind down of some of their portfolios. Now, some of them, such as Brookfield, have committed to redeeming all their investors in full, and so that's good news for their investors.
Yeah.
But I do expect that this will play out for a little longer, and probably put a cloud on the entire sector until hopefully the loan portfolios turn out to be good, or investors do get cashed out.
Now, is this something that needs more legislation, do you think? More rules surrounding it?
Well, I think certainly there needs to be more spotlight into how investors are being marketed for these products, because again, like, they were marketed as safe fixed income when in reality they are levered high risk loans, right? So I think there has been a mismatch, and you're seeing that today with all the investors that are trying to pull money out of these things and finding that the liquidity is not there.
All right, we'll wrap it up there, but we've got lots more to talk about. Coming up after the break, Starbucks is rolling out a new program to address employee satisfaction in America. Is it a means to avoid further unionization? We'll find out with our next guest. And our phone lines will open soon for our first call segment, 1-855-326-6266. Send us an email, first call at bellmedia.ca. Traffic through the Strait of Hormuz is climbing as countries secure safe passage deals with Iran. 21 ships transited over the weekend, the highest level since early in the conflict. Despite the recent traffic, this is still far below the roughly 135 vessels that passed daily before the war. Iran is granting exemptions to select partners while advancing legislation to formalize transit fees, potentially tightening its grip on global energy flows. Barrick Mining is slowing development of its Reko Diq project amid escalating security risks in Pakistan. The company says it will scale back spending and extend its project review to mid-2027, citing worsening regional security conditions and potential increases to capital costs. Barrick still sees long-term value in the project, but warned costs could rise from earlier estimates of roughly $5.6 billion to $6 billion for Phase 1. OPEC and its allies agreeing Sunday to raise their oil output quotas by more than 200,000 barrels a day for May. The modest increase reflects the fact that many of OPEC's key members are unable to raise production due to the U.S.-Israeli war with Iran. Saudi Arabia, the UAE, Kuwait, and Iraq are the only countries in the group that were able to significantly raise production prior to the conflict. And looking at the markets, you can see a little bit of confusion to start the week after a holiday weekend. The Dow off by 0.14, the Nasdaq up by 0.35, and the S&P 500 pretty much a wash right now. Starbucks is doubling down on its Back to Starbucks transformation with a new program that expands tipping options and bonuses based on performance. It may come with higher near-term labor costs and keep further unionization at bay. Here to discuss the new program is Nick Setyan, Managing Director and Senior Equity Research Analyst specializing in the restaurant industry at Mizuho Americas. Nick, thanks very much for joining us today.
Thanks for having me.
What exactly is this program? Let's talk about the tipping part first. Are we going to be paying? Are we expected to put in more tips now?
You are, your loss is going to come with a side of guilt. And so you certainly are going to be expected when ordering digitally you're going to get a pop-up saying, hey, would you like to tip? And before it did not exist.
And do they think that will work, or I mean, doesn't that run the risk of driving people away? A lot of people, you hear them talking about how they're tired of tipping.
Well, it's definitely awkward for the customer. I mean, I think what they're betting on is, that the customer has gradually gotten used to it. If you order on third-party delivery, et cetera, and many other apps, you're asked to tip. And so Starbucks is actually now one of the few apps where you're not asked to tip. And so they're really just joining the fray. And the hope is to switch, the continued labor inflation onto the shoulders of the customer as opposed to the shareholder. There is ongoing labor inflation, and the goal is to essentially mitigate that by, at least for this year, putting some of that on the shoulders of the customer.
So the bonuses, I think, are tied to sales and customer service. So do you think that this is going to increase accountability at the store level, or do you think it's just going to create more competition among the workers?
I do think that it's going to increase accountability. I mean, I think what they're doing is aligning the bonus structure with what you see across, many other restaurant chains. Starbucks was a little behind, given not necessarily behind, but a little different in terms of what their focus over the last few years was, particularly around digital transactions and speed and throughput. I think now the focus is going to be a little bit more on service metrics as opposed to operational metrics.
And I guess the bigger question, does it feel like this is going to work? Is Starbucks heading in the right direction?
Near term, we are seeing an acceleration in traffic trends. To me, I think this is neither here nor there. I mean, I think it's at the end of the day going to be a neutral impact on transaction trends. And on the margin, it should mitigate some of that labor inflation that, we all expect to continue.
So do you think that Starbucks could expand this program beyond the US and into Canada as well?
I do. I think it's a high probability scenario.
Are they the same, Canada and the US, or are they very different beasts?
They're very similar. In fact, when they talk about the business, they talk about North America versus the rest of the world, and that includes Canada. So the U.S. and the Canada operations are very similar.
And would it be difficult to bring that in here, or are the rules essentially the same in Canada as in the U.S.?
I don't think it would be very difficult to bring that to Canada. So I do think it's a very high probability scenario that you guys start to see, tipping prompts on the digital apps as well.
And then from the union perspective, do you think this will help keep the unions at bay?
The unionized stores are about 5% of the system. I don't think that it's going to keep the unions at bay. I mean, at the end of the day, they've seen wages, cash wages, prior to any benefits, et cetera. Cash wages have doubled at Starbucks since 2019, with the hope that it would keep the unions at bay, and it hasn't, right? It hasn't resulted in any kind of a slowdown in the unionization movement. And so I don't necessarily think this is going to keep the unions at bay.
And then I think big picture, do you view this as kind of reinforcing the back to Starbucks transformation strategy, or is this more of an incremental move?
I do think that it reinforces the focus on service. That's part of the back to Starbucks strategy. And at the end of the day, it does, on the margin, mitigate some of the labor inflation. The context is Starbucks has gone from over 20% North America operating margins to low teens operating margins. So we've seen about a 10 percentage point decline in operating margins, in profitability in North America. And that includes a lot of the investments around Brian Nichols' turnaround strategy. And so anything that they can do on the margin to mitigate the cost headwinds is welcome.
Is there more that could be done, do you think?
I definitely think that, costs are going to be a focus going forward. I think the North American margin expectation is that we're going to expand from sort of that 12 to 13% range towards 17, 18% over the next 3 years or so, 3 to 4 years. Investors need visibility that that's a realistic scenario for the share price to go higher and valuation to go higher. What we've seen is an acceleration in top line without a commensurate uptick in the share price. And that's because of the skepticism around the margin trajectory.
All right, we've got to wrap it up there, Nick, but thanks very much for joining us.
Thanks for having me.
Nick Setien is Managing Director and Senior Equity Research Analyst at Mizuho Americas. Still ahead, today's market drivers with Bloomberg's Divya Balji, and our phone lines are open. Ernest Wong is taking your questions on North American large caps. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca. All right, for a look at some early market movers, we're joined now by Bloomberg's Divya Balji. And Divya, thank you as always for joining us. Of course, she's the managing editor for Breaking News Americas. And our topics we're talking about today, Carvana, not Nirvana right now, is it?
No, not at all. This stock seems to be sputtering just a little bit at this morning in pre-market trading. It's down about 2% last I checked. That's primarily because of a downgrade from Bank of America, giving it a hold equivalent rating from a buy. And they're specifically pointing out to macro events, namely, the volatility in oil prices and also industry events when it comes to buying and selling of cars. What they're pointing to right now is this volatility in oil prices are possibly hurting lower and middle income customers of theirs, and that could actually be pulling back on the possibility of sales of their cars right now. What they do point out is also the fact that 2-year rates are a little bit more manageable at this point, so that could actually help with car loans. And in that sense, the risk reward might be a bit better at this point. But still, stock is down just a little bit. I would also point out that the stock is down 26% this year, but it did have 3 years prior to that of epic rallies. One was 1,000%, and the other two were over 100%. Still, with its decline this year so far, its share price is trading below the close of December 31st. So a bit of pain being felt by Carvana right now.
And any other reasons for that drop for the year?
Yeah, I think it really comes down to the fact that consumers might potentially be looking at spending more on the things that they need instead of the things that they want. If you have a car that's currently working, are you going to spend more money on buying a new car? Even if it is a used one, would you just hold on to the car that you have, considering the fact that prices just keep going up in the current environment that we're in? Add to that just the fact that oil prices are elevated right now. It's possible that they drop in a few weeks depending on what happens with Iran, but still, people might just be feeling a bit jittery when it comes to purchasing a car at this point.
All right, if she runs good, hold on to her. Rocketing on a Barclays upgrade.
Yeah, this also sort of has to do with the Iran war. Barclays is giving it a bit of an upgrade at this point, and they're pointing to the fact that, they have seen for the first quarter at least elevated mortgage volumes, and they expect that to continue for January and February. In particular, those mortgage volumes were much higher in March. They have softened a little bit. They're also talking about how prepayments when it comes to mortgages were on the rise in the first quarter. Barclays is giving a base case of the fact that the Iran war will likely come to an end sooner rather than later, which will continue to help rocket companies or rocket cos when it happens, when people are looking at mortgages at this point or looking at buying homes. So still a bit of an optimistic outlook for rocket cos. They also upgraded First American, a similar company to Rocket, with a similar reason as well. Rocket is down about 20% this year. So that also makes this a little bit more of an opportunistic buy for investors that are looking at that specific sector. Same thing with First American. It's down about 17% from its highs earlier this year.
All right, we'll wrap it up there, Divya, but thank you as always for joining us.
Thank you.
Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including MDA Space. Let's take a look at some of the notable analyst calls and recommendations. JP Morgan has initiated coverage of MDA Space, with an overweight rating and a price target of US $34. The firm notes MDA's satellite business has significant potential for growth thanks to new capacity, with exposure to both commercial and military demand. For more on this, let's bring in Ernest Wong of Baskin Wealth Management. Ernest, are you a space fan?
I am. I'm
How
a big
cool.
Star Wars guy.
A Star Wars. Okay, well, it's not real, but I won't ruin your dreams on that. No, but how cool was it watching Artemis take off?
It was an unbelievable moment. Obviously, I wasn't around when the last time that people reached the moon, but it was certainly something that I was very excited about.
So what do you think of the space industry in general? Is this going to reinvigorate it? Does this present all kinds of opportunities?
Well, I think even before the event, there was space has been a significant area of interest for investors, partly because of SpaceX and the upcoming IPO, and the idea of when Elon Musk talks about potentially having data centers in space. So it has been a hot topic and one that investors are quite excited about.
And where do you see the opportunity? I mean, it seems like Canada does have some pretty good chances here and pretty good opportunities here, MDA just being one of them.
Yeah, so I think that clearly we are seeing low orbit satellites, such as Starlink, being an increasing, they are disruptive providers of internet, both for people flying on airplanes or for people looking for reliable internet in rural areas. And I think in Canada, these are capabilities that we should certainly have in-house. And I think there's not really too many public ways to play this. And I think that's partly reflected in the enthusiasm for names like MDA Space.
And also launches. I mean, we've been trying to get a spaceport going in Nova Scotia. Are those possibilities for Canada too, do you think?
Well, I think certainly that, looking beyond things like Star Wars and things like that, I think that space is really a defense and geopolitical issue where having the capability to launch satellites is a defense and a government priority at the end of the day. So I think that is certainly something that, as the U.S. talks more about its allies taking more and more of the defense load and sharing of the budgets, that is something that they will continue to expand.
Okay, and then SpaceX itself. They're talking about $1.75 trillion, I think, is now the number being bandied about for its IPO. Is that realistic? Is it worth it?
Well, I think part of it is a bet on Elon Musk and the ecosystem that he's built with his AI investments, with Tesla, and with self-driving, and kind of this whole vision of building futuristic technologies. I think clearly SpaceX has been a very disruptive force in some of the markets that they are serving. I don't really have an opinion on the valuation, but I think there's no doubt that he's done an incredible job building the business.
But definitely, it feels like there is that almost a rebirth of the space industry.
Exactly.
And we forget how many satellites are up there. I think the next one is probably a garbage collector up there. There's got to be a company that can figure out how to get up there and collect all the garbage that's up there.
Well, I think that has certainly been something that has been an increasing issue with the low Earth satellites. Due to the idea that there is now an increasing amount of stuff that's just floating around the Earth.
Yeah. And Artemis, too, before we head to break, they're expected to reach the far side of the moon in just a few hours. So that's very exciting. What's your favorite Star Wars movie?
It would have to be the third one.
The third one?
Yeah.
Oh, okay. Wait, hang on.
Revenge of the Sith.
Oh, really? All right. We'll leave it on that note there. We've got more coming up here with Ernest Wong of Baskin Wealth Management. Stick around. We'll be taking your questions on First Call. All right, time for First Call and first email. For that, we go to Ted, who asks, could I please get Ernest's opinion on Brookfield Asset Management? Bam! Chef Emerald. It's been dropping recently. Can we expect a turnaround soon? Thanks.
Yeah, so Brookfield Asset Management has sold off in sympathy kind of with other private equity firms due to worries about the whole private credit and private equity ecosystem.
What we're just talking about.
Yep, I think Brookfield is actually quite different from some of the other firms. They do have a private credit business, but much more focused on backing hard assets. So things like real estate, things like infrastructure, rather than software-related buyouts.
Yeah.
They have talked about this where their exposure to software is very, very minimal in their credit space. And I think more importantly, Brookfield is, they mostly focus on institutional investors. Retail wealth channel has been something that they've been working on, but is a much smaller percentage of their assets relative to some of their peers. So no real risk that they have to gate their funds or anything like that on a massive scale for Brookfield Asset Management.
Now, and is commercial real estate, is it taking the same hit that we're seeing in the in private real estate in the housing market?
No, so they have at the parent Brookfield Corporation, they do own a large commercial real estate property portfolio that they acquired in the pandemic. They have been working to kind of unwind this portfolio and wait for better valuations to sell it off. I think from the perspective of Brookfield Asset Management, most of their real estate funds are still doing well. They're still raising money for new opportunistic real estate funds. So there's still clearly investor demand for their products.
Okay. And where are they focusing?
It's a global.
Okay.
And so one example is that recently they launched a new AI infrastructure fund. They're seeing very strong demand from investors for building data centers and these kinds of things.
All right, let's get to this next email from John. The host provide his thoughts on Alimentation Couche-Tard, ATD. Why is it so volatile? Would he buy in at the current price?
Yeah, so I think there is a mixed impact of high gasoline prices on a company like Alimentation Couche-Tard, where on the one hand, in periods of high gasoline prices, people generally fill up less at the pump, and that is going to drive slightly lower visits to the convenience store. But on the other hand, when fuel prices are volatile, they generally make more money per barrel of gasoline. So they're making a little bit more money. And I think what has transpired for gas station chains is that the convenience store transaction has largely become detached from the fueling transaction. And so sophisticated operators like Couche-Tard that have really built out the backcourt to sell things like tobacco, energy drinks, coffee, and increasingly fresh food, they are able to gain market share in times of high gasoline prices from weaker independents who are more reliant on the pump.
So you see an opportunity here then?
Yes, exactly. And so I think what will happen is that Couche-Tard and some larger chains will gain market share and maybe have opportunities for acquisitions as well.
Okay. This email is from Brian. I would like to ask the guest about Canadian natural resources. What would be a good entry price to take a new position?
Yeah, so not surprisingly, it is a major beneficiary of higher oil prices. But not only that, we're seeing synthetic crude oil, which is kind of refined bitumen products, that has traded at a very high premium to, I think, about $19 per barrel to WTI over the last couple of weeks. So benefiting from multiple ways. I think for Canadian Natural, the thing that we are looking for is that they recently updated their capital allocation policy so that they are going to accelerate returns to shareholders when they reach a certain net debt target. Now, I think what we saw in 22 in the last period of high oil prices was that they took the opportunity to pay special dividends. And so I think we'll probably see some of that going forward. The other thing that I think we're watching about Canadian Natural is that in their last earnings call, they had talked about deferring some engineering work to do a major expansion of their oil sands projects because of unclear government rules on methane. The government of Canada has now reached a deal with Alberta regarding methane emissions, so we'll see if they are going to change their mind on that.
Okay, let's try and get a couple of more emails in. This one is from Dave. Is Manulife a buy, hold, or sell at this time?
So I think life insurance companies in general, they have increasingly become asset management companies. And especially they have really benefited as from the last period as life insurance has become a good way for private asset managers like Brookfield to fund some of their products. Now, I think for Manulife, I think the key is that if we do get into a higher interest rate period, how are they managing their balance sheet? Because in the past, they've been stuck with kind of high, very interest rate sensitive portfolios.
Yeah.
So that would be something that I would be paying attention to.
Okay, we'll wrap it up on that note there. Ernest, thanks very much for joining us. We always appreciate it. That is it for us here on The Street. Thank you to Ernest Wong for joining us today. And he's up next with the Open. Trading gets underway in a little more than 30 minutes from now. Have yourself a great day.